9 o'clock on my side. Let me greet everyone. Good morning, everyone. My name is Malungelo Zilimbola, and welcome to our Africa webinar. Just a quick background on Mazi Asset Management. Mazi Asset Management is a 19-year-old asset manager managing 51 billion of assets under management across all the different asset classes. And we have presence in South Africa, in the continent, and globally. Today, we're going to talk about the subject that is overlooked, but yet very compelling. We're going to talk about investment across the continent. Over the last decades, a lot of investors, South African and globally, have overlooked this continent, despite stellar US dollar returns that it has generated. And it has generated these returns in spite of the headwinds that Africa is facing. Regulatory risk, capital flight, COVID, even the currency risk. And investors have chosen to invest in the global indices, which are largely American, and even going into speculative assets like cryptocurrencies. The regulatory change in South Africa in 2022, where the Minister of Finance increased the foreign limits to 45% without a specific allocation to Africa, meant that South African pension funds took their money offshore and invested in the global indices. That exacerbated the situation of capital outflows in Africa. And today, to help me delve deep into this subject, I've got my colleagues, Keonethebe and Moses. And I'd like Moses and Keonethebe to introduce themselves.
Good morning, ladies and gentlemen. My name is Keonethebe Bosigo. I'm the portfolio manager for the Mazi Africa Fund. 2025 actually makes 20 years since I've been in the industry. I joined Mazi in 2013 and I've been managing the Africa Fund since 2015. Before Mazi, I was at Old Mutual as an analyst and assistant portfolio manager for the same fund, for the Africa Fund. And before then, I spent a couple of years as a manager research analyst in the multi-management space. And I actually started my career in technology or IT as a business analyst. Over to you, Moses.
Thank you very much, Kyo. Good morning, everyone. My name is Moses Njuguna. I joined Mazi in October 2024 as an investment analyst on the African Fund with Kyo. I have about 15 years of Africa-focused experience. I've been analyzing listed African companies in that time. And before I joined Mazi, I was at EFG Hermes for the last 7 years on their research team. Thank you very much. Over to you, Malu.
Gentlemen, in framing the landscape, Kyo, let's start with a big picture.
Yeah, thank you, Malu. The year 2025 has been marked by significant geopolitical shifts with long-term implications for the investment landscape. Ongoing conflicts in Europe, the Middle East, and the indiscriminate imposition of tariffs by the US and the growing influence of regional powers like BRICS are forcing world leaders to ask serious questions. Are we witnessing the end of an era of capitalism and free trade? And critically, how do we as investors effectively allocate capital in such a dynamic environment? One of the most pressing issues is the rise of tariffs, which would likely negatively impact global growth. Tariffs are a cost that is ultimately paid by someone, whether it's the consumer through higher prices, the importing company by taking a hit on their profitability margins, or the exporting company also by taking a hit on their profit margins. Either way, the result is a slowdown in global economy. There's no way to sugarcoat it, really. Higher prices will lead to higher interest rates that might stay there for longer, forcing central banks to prioritize inflation over jobs. And if this becomes widespread, we could face a period of high inflation, low growth, a period experienced in the 1970s in the world, and a phenomenon known as stagflation. And how does this impact Africa? Africa has felt the pressure through both sides. If you remember, in January, the US aid funding was cut on the continent. Most of this money went to funding programs like healthcare. Some of it was for development financing. Surely this will, in the short term, impact the growth outlook for the continent. But we are positive on the long-term prospects of the continent, especially if you look at the last 3 years where the African countries have gone through various structural reforms to position the countries for or strengthen the country's economic systems and position themselves to be able for resilience going into the future.
Yeah,
Moses?
Yeah, thank you, Keo and Malu, for that question. I mean, it's very interesting that when you look at the rest of the continent as a whole and the sort of resilience that we've seen in the last 3 years. I mean, for example, if from the African Development Bank, despite the challenges, the global uncertainty and challenges that we're facing, they still expect half of the African countries, that's 21 countries, to record at least 5% GDP growth in 2025. And more interestingly is that they expect that 4 of them should attain at least 7% GDP growth. These are very, very strong numbers and track record and expectation from the African continent. On the structural reforms, in the last 3 years, when the new government came into Nigeria, as an example, in 2023, the first thing that they did is to start removal of the fuel subsidy. This is a subsidy that was taking away about $7.5 billion a year. So that's a cost saving to the government, and these are funds that they can direct into other economic areas of Nigeria and to build that the economy in general. Additionally, they basically liberalized the FX, where we've seen currency devaluations, and that has made Nigeria even more competitive. Additionally, they have strengthened their security in the agricultural sector to ensure that Nigeria becomes food sufficient, as well as in the oil and gas segment, where oil theft has drastically reduced in the last year or so. So these are the sort of steps that some African countries are taking, and it highlights the resilience across the rest of the continent in Africa in terms of GDP growth and expectation that they will remain resilient despite the global uncertainty. Over to you, Malo.
Thank you, gentlemen. And by the way, ladies and gents, you'll have time at the end of the session to ask your questions. And Nolita will be looking out for those questions for us. Keo, let's build on this optimism. Why do you believe Africa remains such a high potential long-term investment play?
Absolutely, Malu. We believe the African continent is brimming with opportunity and alive with potential. And for the astute investor, the case for Africa is built on four pillars that drive long-term growth. These 4 pillars, we define them as diversity, consumer demand, financial access, and infrastructure. Starting with diversity. The African continent is often painted with a single monolithic brush, which is a fundamental misconception. The continent is a home to 54 distinct countries, over 2,000 languages, a vast array of cultures, with an aggressive GDP of $3 trillion in 2025, according to the IMF. This incredible diversity offers a wide range of investment opportunities, from the oil-producing West, powerhouses like Nigeria, to the tea and coffee exporters of Kenya, in the East. And each economy has its own unique drivers and characteristics. Notably, Africa hosts 30% of global mineral reserves, over 65% of uncultivated arable land, and over 600 million hectares of forest, and some of the longest rivers in the Nile and the Congo River. AFDB highlights that Africa can mobilize up to 1.4 trillion in domestic revenues through better policies, mobilizing capital, and tackling resources leakages. Talking about the consumer, Africa is home to 1.4 billion people, over 60% of which are under 25. If you go to Europe, Western Europe has an average age of about 43. And then actually Eastern Europe has about an average age of about 41, which is, I mean, the difference there is very small. And coming back to our continent, this population that is under 25 is projected to be 25% of the world's population by 2050. And this demographic boom, coupled with a strong economic growth, will support the rising income levels and massive increase in consumer spending. And as income rises, we will see aspirational consumers drive formalization of retail and demand of premium goods and services. And companies that can provide locally focused, relevant products are poised to benefit from this. And just to put this into perspective, I mean, as South African investors, when you want to buy groceries, you go to ShopRite, you buy nicely packaged meat at an affordable price. Yes, inflation has been high for the past couple of years, but that is not the case across most of the continent. You know, you go buy fresh bread produced by Tiger Brands in Albany, or Premier Foods, or in Blue Ribbon, I think. You know, but such luxuries or things that we take for granted don't exist in Africa. Talking about retailization of the continent, I mean, that presents a significant opportunity for companies and investors that are astute, that understand the demands of the local communities or the local countries to take advantage of. Going to financial access. Financial inclusion remains a significant challenge, with less than half the population having access to formal financial systems. Here, I'm talking access to banks. Hurdles like physical banking infrastructure, high cost of traditional banking have left many behind. Mobile network operators and fintech companies have stepped in to bridge this gap. The rise of mobile money has been a game changer on the continent. Using existing distribution networks, here I'm talking about cell phone networks, to offer low-cost financial services to millions of people across the continent. Best examples being M-Pesa in Kenya. You can talk about Momo in Ghana and in the Francophone countries. This has given a lot of people that were previously excluded from the financial system into the system. We talk about payments. Less and less cash is being used in countries like Kenya, as people now are using payment methods like M-Pesa to not only move money around, pay people, and taxis and stuff like that, but also to transact on a daily basis, like buying an apple in the streets. Finally, infrastructure. Africa has a significant infrastructure deficit across almost every sector. Whether we're talking about energy, transport, healthcare, education, the IMF or the World Bank, for that matter, estimates that Africa needs between 130 to 170 billion annually to address this gap. I'll make a simple example. Currently, the buzzword in the world in technology sector, we talk about AI, we talk about cryptocurrencies. But if you look at what's supporting this, I mean, there is a lot of investment globally in big countries like America and China into energy infrastructure, because AI or artificial intelligence does not exist without power infrastructure. AI consumes a lot of energy. So countries are investing in a lot of energy. Africa needs to invest in energy for its own long-term development. We talk about e-commerce. Here in Johannesburg, we are spoiled. You can order Uber Eats and your food or your pizza arrives at your house while still warm and nice, and you can enjoy that. You can order Checker 6060. But if you think about it closely, that Checker 6060, Uber Eats, or even Uber itself would not exist or will not be functional without having a proper road infrastructure in place. So Africa needs to invest in this infrastructure to allow itself to prosper in the future. Over to you, Moses.
Oh, thank you. Thank you so much, Keo. And you're very correct. I mean, you can't undermine the potential that Africa offers. I mean, you started off by talking about the diversity that we have in this continent, and you mentioned the long rivers that we have in the Nile, which is the #1 longest river in the world, and the Congo. I just want to add a few things in relation to that and the economic potential that those two rivers only, has on the countries that it flows through. For example, I mean, if you look at the power segment, I mean, the Congo River, according to IEA, has a hydro potential of 100,000 megawatts. Basically, what that means is it can produce power for the entire sub-Saharan Africa with surplus exported to Europe. So it shows you the sort of natural resources that Africa has, and if utilized properly, can basically catapult Africa to be a superpower globally. Additionally, if you look at other segments in terms of tourism, in the Nile River, they're using that as a tourism hotspot with, boat rides and stuff. If you're looking at, agriculture in terms of irrigation, if you're looking at, transport and navigation, moving to boost trades, in the DRC using the Congo River as well as the Nile across all the countries that it passes through. It is estimated that about 300 million people currently rely on the Nile, and about 190 million people rely on the Congo River for their livelihood. So it shows you the sort of natural resources that Africa possesses. And in terms of the labor that Africa has, labor productivity, it is estimated that Africa is expected to have the largest workforce of about 1.1 billion people by the year 2050 or even earlier, and this is bigger. Just put in context, it is bigger than China and India. So the potential of having Africans being employed in Europe and China and having those remittances coming back to the continent is extremely high. If you look at AFDB statistics, they talk about $100 billion in terms of diaspora remittances expected in 2025, and that is expected to grow to about 283 billion by 2035. This is 3 times what the continent received in terms of diaspora remittances in 2023. So the potential is vast and speaks to the $1.4 trillion in terms of domestic revenues that Africa can mobilize internally rather than rely on, cash or on external cash inflows. Additionally, I just want to add on, the financial access. You spoke about M-Pesa. As a Kenyan, I attest to that. M-Pesa is ingrained in our day-to-day life. I mean, we do transactions for every aspect in terms of payments, in terms of savings, in terms of wealth management. All that is done through the mobile phone. And just to put in perspective, as a bird's eye view, if you look at the GSMA statistics in 2024, they state that about 2 billion registered mobile money accounts are have been recorded globally, and about 1.1 billion of those accounts are African. If you look at the monthly active users globally, it's about 520 million users. If you compare that to Africa, Africa accounts for about 283 million of that. More than half of the global monthly active users are in Africa. And in terms of the transaction value, last year it was 1.1 trillion in transaction value. It was about 1.68 trillion globally. Africa accounts for 1.1 trillion. So it shows that Africa is a global powerhouse in terms of mobile money in the world. And finally, just to build upon on the infrastructure, I just want to give an example. If you look at the housing sector across Africa, it is estimated there's a shortfall of about 51 million houses in Africa. And the largest contributor to that is in Nigeria, where there's a shortfall of between 17 to 20 million units in terms of shortfall. So there is a lot of potential in Africa. And I'd like to segue into the African Continental Free Trade Area. This is something that was launched in 2021. The 54 African countries have signed it, but only 47 have ratified it. This is supposed to create a free movement of goods, free mobility for the African people to move across the continent. And it is expected, according to World Bank's estimates, that this Africa Continental Free Trade Area can lift 30 million Africans out of poverty. It can increase intra-African trade from 15% currently to 52% by 2035, and more importantly, build upon the aggregate GDP in Africa, which currently stands at 3 trillion, to build that up by adding another $500 billion to the Africa GDP. So there is massive potential in Africa. It's just that we need to utilize and put the necessary infrastructure in place to efficiently exploit the potential that we have. Over to you, Malu.
Wow, that's amazing, guys. I can see that there's massive potential in Africa. You guys mentioned the water, you mentioned the land that we have, the climate, and most importantly, 1.4 billion people, and which are young and with a high growth in terms of of the population, while the developed West is struggling with aging population, and even places like China, for example, there's labor shortage as we speak. South Africa, you talk about the workforce, Moses, of Africa that's growing, that's getting more and more productive, especially with technology. South Africa, ladies and gents, has not been left behind. In fact, we are leapfrogging the developed world as far as the new technology is concerned. There is e-commerce in Africa, as Keonethebe has said. There is AI in Africa. In fact, banking, we've leapfrogged building branches that are very expensive, and we've moved to mobile money. All you need is your handset, you need a smartphone, and you need an internet, and you need electricity to charge your phone, and you are in the game. But ladies and gents, we're going to tell you how you access these opportunities. So Keonethebe and Moses, How do you access all these opportunities while at the same time managing risk?
Thank you, Malu. There are actually several ways for investors to gain exposure to the Africa growth story. We can start with public equities. The most direct route is through the equity markets, where the fund like the one that we manage here, the Mazi Africa Fund, provide easy access. This fund has a strong track record of producing consistent above benchmark returns in US dollars since it's launched in 2015. There are other ways like listed debt. Africa listed debt has delivered equity-like returns in recent years and continues to offer attractive yields. And here we're talking about both local currency debt on the continent and Euro bonds on the continent. And here at Mazi, we are in the process of launching an Africa bond fund to capture these opportunities. We also have infrastructure funds and private markets, which are other avenues at which you can access this investment opportunities on the continent. Here at Mazi, we have the infrastructure fund, which focuses on power and water projects as well. And also, the other opportunities are private equity and private credit vehicles, which have become key asset classes on the continent. And just on private credit, I read an interesting stats that for the last couple of years, private credit on the continent, the default rate has been at 3%. This is private credit. It's not credit to the government. It's credit to the individuals and corporations. It just indicates the risk environment on the continent. And how do we approach this? From a risk perspective. At Mazi, we define risk very simply as a potential for a permanent capital loss. Like any investment destination, Africa has its risks, but these are not unique or daunting as often as perceived. As we mentioned above, that private credit has the default rate of 3% on the continent. And other risks that emerging and frontier markets that we face are liquidity and potential delays in repatriating funds. However, we believe that the negative headlines often skews investor sentiments far beyond what's real. And our analysis and experience has shown that a patient investor can eke out significant returns from investing on the continent. And for us at Mazi to navigate these landscapes in managing our funds on the continent, we run risk monitors like a country risk monitor. A country risk monitor, we look at elections calendars, who is running for, I'll make an example, in January, when we come to the office, we'll look at the election calendar across the continent, which countries will be hosting elections, who are the runners in those elections, what are the runners' economic policies, and how are those policies likely to affect fiscal policy, monetary policy, and how is that likely to impact the currencies of the respective countries. We also run very diligent liquidity risk monitor. As I mentioned, liquidity is one of the very important risks that we look at on the continent. And Africa has very few or has a very challenging liquidity issues. But by managing, running a tight liquidity screen, this can guide us how to invest and where to invest, and how to manage the fund in such a way that we don't impair our clients' capital. Over to you, Moses.
Thank you so much, Kio. The question of risk or in the continent and the perception that Africa has significantly higher risk, led me to reading a speech from Professor Ken Urama, who's the chief economist at the AFDB. This is a speech he delivered in 2023, and I'm going to read it verbatim, just a section on what risk perceptions people have globally on the continent. So this is based on a report that AFDB did, the Regional Economic Outlook. And in that report, it found that, contrary to risk perceptions driven by the sovereign ratings of African countries, Africa has the lowest risk of default compared to its peers. A 14-year study by Moody's Analytics revealed that Africa had the lowest default rate on infrastructure investments worldwide at 5.5%. But the next sentence is critical. In 2020, Moody's Analytics updated its figures. The report covered more than 8,000 project loans from the consortium members originated from 1983 to 2018. It reported that Africa is still the least defaulter among the main regions, with just a default rate of 1.9%. And this is in stark contrast to Eastern Europe at 12.4%, Latin America at 10.1%, North America at 6.6%, Asia at 4.6%, and Western Europe at 4.6%. I mean, this is very, very interesting in terms of the risk perceptions that people have of the continent vis-a-vis the developed world. Again, it keeps on stating that in the next sentence that there was a study done by the UNDP, which cited that indeed that African countries could save nearly $75 billion in excess interest if credit ratings were based on more objective assessments of risks. So this basically highlights the risk perceptions that, the developed world or other investors may have on the continent that, it's high risk, therefore we need to charge them a higher interest rate. But in reality, as highlighted by, the report done by Moody's Analytics, Africa has the lowest default rate globally and can save more than $75 billion in interest if credit ratings were done on more objective assessments of risk. So we just needed to highlight that. Thank you very much. Over to you, Malu.
Thank you very much, Keo and Moses. That was really well put in terms of how you manage risk. And highlighting the point of, risk perception in Africa. If you look at those default rates, it's amazing that South Africa has got such low default rates, and yet the perception is quite the contrary. So guys, in terms of then making a case for African equities, and most asset managers have closed down their African funds, while Mazi has remained committed and remained in the continent, and hence we have this fund of ours that has done very well over the last 10 years and really produced, as I mentioned, hard currency returns at very minimal risk. Now, Keo, let's bring it closer to home. What is the tangible benefit of adding African equity exposure to a typical South African balance fund?
Yes. Thank you, Malu. This is a very crucial point, and data speaks for itself. First, let's talk performance. Over the last 5 to 10 year periods, most African markets have generated returns in line with the SWIX or JSE shareholder weighted index in both dollar and rand terms. In fact, if you were to exclude the outsized performance of Naspers and Prosus from the JSE, the African frontier markets would have convincingly outperformed. And second, and perhaps the most important, is diversification. African markets are very different from almost any other markets in the world. Not only they behave differently from any other markets in the world, even they between themselves behave very differently. For example, Kenya behaves differently from Nigeria. And this is simply because Kenya is driven by different factors from the factors that are driving Nigeria. Nigeria is an oil exporter. So commodity prices are very important in Nigeria. Oil price is very important to the economic trajectory of Nigeria. Though the country, as Moses has mentioned, it is diversifying away from commodities and is becoming more and more, due to structural reforms that they have implemented in the last 3 years, diversified economy, while Kenya benefits from lower oil prices. So they behave totally different. And we looked at the equity markets for since 2005 across the continent, the data, and you look at the correlation between the countries on the continent, totally different, meaning that you can diversify your portfolio by just investing in Africa, And also, data has shown us that if we model a relatively small, let's say 5% strategic allocation to African equities or even African debt, like I said, African debt has produced equity-like returns in the past couple of years. To a typical South African balanced portfolio that can invest offshore, the results are clear. This small allocation, I'm talking here 5%, would not only positively contribute to performance, it also reduces the perceived risk or the actual risk in the portfolio as measured by the Sharpe ratio. Our conclusion is simply African assets offer South African investors significant long-term benefits in both return enhancement and diversification. And the perception of risk that Africa is too risky is not supported by data. The continent's markets have been more volatile, have been less volatile than SA, for example, in dollar terms, and they have produced comparable returns. There's a clear and strategic place for an allocation of Africa assets within a well-balanced South African portfolio. Thank you, Malu.
Wow, Kiwa, that's phenomenal. I mean, Africa itself, as you mentioned, 54 countries, and you get natural diversification, both in terms of, the factors, whether it's driven by oil or driven by food or agriculture. And, you've got that natural diversification. Or even the currencies for that matter. The different currencies in the continent provide you with that natural diversification. And let alone Africa being uncorrelated to other markets, including the JSE and even global markets for that matter. Now, Kio, finally, how does a retirement fund put together or build a portfolio, a future fit portfolio, to balance their goals of growth and the goals of protection, and also the objectives of income? So how do you advise the investors to go about constructing their portfolios?
Thank you, Malu. The key is to always start with the investor's goals and their stage in life. Investing in high growth assets like those in Africa is ideal for an investor seeking long-term growth, not necessarily a retiree who needs income and capital preservation. Though there are assets that can cater for that on the continent, like debt assets, like a bond portfolio on the continent that can offer both equity-like returns and decent income for investors. Our responsibilities as portfolio managers is to construct portfolios that deliver satisfactory capital growth over the long term. We do this through disciplined bottom-up process. We work tirelessly to select companies that we believe are future winners, with strong management teams and who are excellent capital allocators. Our return threshold on the continent is very high, and we seek out businesses that consistently produce returns above their cost of capital without taking undue risk. We believe diversification is the only free lunch, not only investing, but in anything, to be fair. We ensure that our portfolios are well diversified across different countries, currencies, industries, and individual stocks to build resilience. Moses, you can provide case study.
Yeah, so ladies and gents, we've got a nice case study for you. I think, the case study is going to depict and showcase all the elements that we've been talking about in Africa, whether it's infrastructure that we've mentioned earlier. So we have a case study for you, and Moses is going to take us through the case study of Dangote Cement. Over to you, Moses.
Thank you. Thank you very much, Malu and Kio. So we started off talking about the infrastructure deficit that Africa has and the potential that it offers. We also touched on the Africa Continental Free Trade Area. So having a company that's operating across the East, West, Southern Africa would be ideal in terms of diversification and positioning itself to take advantage of those two key elements that Africa offers. So Dangote Cement is a Nigerian company. It's a largest cement player in Africa, with about 53 million tons in terms of installed capacity across 10 different countries. So it offers diversification in that respect, as well as positioning itself in high growth markets in Africa. So it has 2.5 million tons in Ethiopia, which records about 7% GDP growth. It also has about 3 million tons in Tanzania, another country that has very high GDP growth rate of about 6-7%. So Dangote has positioned himself extremely well in West Africa, where majority of his capacity sits, which is about 35 million tons in terms of capacity. So he's basically using the parent company or the motherboard in Nigeria, which is blessed with a lot of resources in terms of limestone, to start sending clinker, which is a very important input in cement manufacturing, into its grinding plants in Central Africa. That's mainly in Cameroon as well as Ghana, to increase production rates and supply of cement across those countries. Already he's positioning himself to take advantage of the housing deficits across the continent by positioning his grinders as well as his plants across the continent. Just put in perspective in terms of the capacity that Dangote has across Africa of 53 million tons. If you compare that to the United Kingdom, it's about almost 3 times of what the United Kingdom has in terms of installed capacity. If you look at Africa as a whole in terms of installed capacity, it's about 400 million tons, and 53 million tons, is already owned by one player. And then if you look at other stats in terms of per cement capacity consumption across Africa, it's about 180 kilograms. And if you compare that to the global PCC, which is north of 400 kilograms, it shows you the potential that this segment offers. And this hasn't gone unnoticed by other global players. We've seen the Chinese setting up, buying up plants in Africa and setting up their own plants in Africa. We've seen West China Cement setting up plants across East Africa. We've seen Guangxin Cement from China buying up Holcim plants across East Africa as well as Southern Africa. But Dangote is an indigenous African player and has been performing extremely well. He is the price maker in all the markets that he operates in. He has a significant market share in majority of the markets that he operates in, and this basically highlights our cement company or company that has positioned itself to take advantage of the infrastructure deficit, take advantage of the African continental free trade area that, that will offer significant uplift to his revenues. He's operating profitably in Nigeria, East Africa, as well as Southern Africa. He's a price maker. He's, and he has strong cash generation, which can be allocated to more cement capacities, to increase the cement capacities across Africa, and to build and take Africa where it's supposed to be in terms of infrastructure investments and infrastructure development. So that's a very simple, synopsis of Dangote Cement, but it highlights how an African player is positioning himself to take advantage of the in potential that Africa offers. Thank you so much, Malu. Over to you.
That's very interesting, Keo, Moses. Thank you very much for that case study. And an interesting anecdote is that Dangote has got 60 million tons of cement, and England, the whole of England, consumes 60 million tons of cement per annum. So that's incredible to hear. Now, thank you very much, Keo and Moses, for those incredible insights. I mean, it is clear that while the global environment presents lots of challenges, the African continent holds a unique and compelling set of opportunities for forward-thinking investors. So for us, all of these just tells us that there's so much perception, negative perception, that have been around for centuries about Africa, despite the real numbers that we see in terms of the default rates that are at 3%. And for us, we like to invite questions at this point in time, and really just to encourage the interaction from our audience. And we've had the first question, and Nolita, if you can be on the lookout for further questions there. So, ladies and gents, I'll read the first question. How do you see the advent of AI driving further growth in Africa, practically speaking? Is it possible to shorten some of the long-term planned implementation of projects or initiatives that could drive infrastructure growth? So what are the impediments in terms of of those projects taking off, and also how does AI help us in that environment?
Yeah, Malu, I'll take this one. Just to reread it, like, how do you see advent of AI driving further growth in Africa? If you think about AI, I mean, what is AI? I mean, AI basically just means smart compute, basically, smart computers. It just means improvement in efficiency, like how we do our day-to-day jobs. It just takes out, shortens the time at which people on a day-to-day basis do their jobs, whether we're talking about us as analysts or investment managers, where we can, previously to write an investment report would take you, let's say, a month. Today with AI, the static information, you can easily find it, and it can shorten your work from writing a report from a month to a week or 2 weeks. Whether medical diagnostics, where it makes it quicker for doctors out there to find solutions to medical challenges, and also just in areas like, let's say, architect, drawing, like building and everything. So it introduces the efficiency, and with efficiency, if you think about what drives economies, there's efficiency. It gives people more time to do other things and improves productivity in the economy, and the economy grows. Is it possible to shorten long-term implementation of projects? Yes, it is very possible, and that goes back to this. Just goes back to the basics. Africa needs to cut out a lot of unnecessary regulations, to be able to move forward and implement a project quicker. And then there are other things that involves, for lack of a better word, corruption. We need to deal with challenges like corruption if we want to not only implement projects, but quicken the delivery of projects and stuff like that. That is in our hands. We don't need technology for that. That is just an issue of removing unnecessary regulation and dealing with corruption, in our view.
Moses, do you have anything to add?
Yeah, thank you so much, Malu. Like what you said, AI will bring through a lot of efficiencies, but I think, like he mentioned, we need to have a very strong platform, and that starts from implementing, policies that would make Africa work. For example, if you look at, the Africa Continental Free Trade Area, one of the key themes is mobility, free mobility. But if you read the report of the 2024 Africa Visa Openness, 46% of African travel is still restricted, as a result of visas. In terms of moving from, Keo can attest to this, flying to North Africa, to Morocco, Keo has to fly all the way to France and then back into Morocco, and it takes him a full day of travel. So we as Africans need to remove all these bottlenecks and create that efficient platform before even implementing AI in terms of increasing efficiencies in terms of implementation, and that will basically reduce the projects that we intend to implement. So the first thing is just have the right policies, tackle corruption, seal the revenue leakages, and then we already have AI in the financial sector, coming into the agricultural sector, into insurance. Already that's being implemented, but I think the impact will be more felt if we have a more efficient and platform and ensure that we Africans are working to uplift each other rather than that impediment in terms of the travel, in terms of visas, in terms of other respects. So I think we need to get that first correct, and then we'll see the impact of AI and efficiencies in our projects. Thank you, Malu.
Thank you very much, Moses and Keo. And I also think that with the changes in the trading environment, globally, there's going to be some changes and readjustments in how countries trade with each other. And that Africa trade, regime actually stand Africa in good stead, and it could be a catalyst to actually bring about, the fast pace in terms of reforms, across the continent. So there are a few questions that are coming up, and we appreciate the questions. And so I'll just read the first one, and then I think Keo or Moses, you can jump in terms of answering some of those questions. Africa is often branded as the next frontier for exponential growth, but with slow structural reforms, energy crisis, and debt pressures in many countries, is this narrative realistic, or are investors being sold a dream?
Oh yes, Meshach, it is a realistic dream. We have actually witnessed it. Actually, I'll take it to, instead of talking about maybe the big picture, let's just take it to the companies. This work that we've done over the last couple of years, and this work, by the way, was done up until the end of 2023, which excludes 2024. This work looked at the earnings growth of select a couple of African companies, about 20 African companies, for the last 8 years, including the COVID years. Firstly, the data shows that African companies including all the currency challenges that we've experienced, including all the infrastructure challenges that we've experienced, including debt crises and everything that you've put in your questions. They've grown earnings in dollars. They've basically grown earnings in dollars. Not only that, some of the African countries, African companies, actually most of them that we've looked at, have paid you dividends more than their share price, today's share price. Basically, what I'm saying is that today's share price, you've gotten all your money back over the last 8 years, if you look at their dividends. And for some of the companies, you've gotten your money back 3 times, just in dividends. So we're not being sold a dream here. Our view is that it is the perception that Africa is risky. I mean, you talk about debt pressures. Moses gave you statistics. For the last 100 years, 1.9% default rate on the continent versus 4% in, Moses can chime in here, 4% in Western Europe, 12% in South America.
Yeah.
Our contention here, or Mishak, that is that the challenges in Africa tends to be overblown versus reality. So you're not being sold a dream here. It is real, and the returns are real.
Moses, do you want to come in?
Yeah, thank you, Malu, thank you, Keo. I mean, yeah, I mean, there is perception, like I mentioned earlier, you know, Western Europe, which is highly developed at 4.6%. And like I mentioned, the default rate in Africa is less than 2%. You know, that basically highlights, you know, the impact of risk perception on Africa. I believe the potential is real. Africa is the next frontier, you know, and this is, you know, if you look at the investments made by the Chinese in Africa, if you look at, you know, like I mentioned in the case study, the Chinese are investing in Africa. That's where they're seeing growth, their next growth that will support their revenues coming from, and they have invested heavily in countries like Ethiopia, which has a very high GDP growth rate, and in the southern African countries, in Zambia, they have invested there. As we speak right now, Wangxing, which is a Chinese cement player, is looking to acquire Holcim's cement assets or cement plants in Nigeria. So the Chinese are making significant investments in Africa. So that basically shows you that even, you know, a global, you know, superpower like China views Africa as a next frontier, as a next growth phase for their companies. So I do believe that Africa is the next frontier, and it is not a dream. I think we are going to realize that potential sooner rather than later. Thank you, Malu.
Yeah, and also, I mean, besides the institutional investors that are investing in the continent, you also have corporates. For example, corporates, you know, in South Africa investing in the continent. You can talk about MTN, who's now his biggest profits come from Nigeria, and you can talk about, you know, the multi-choice of this world that also invest across the continent. You know, you see DP World, which was the old Imperial, that are building ports, you know, across the continent, which is a Middle Eastern company. So there are corporates as well that are doing the work on the ground across the continent, and I think it's not only the institutional investors that are sold a dream here. So maybe this one is for you, Keo. It's also talks about the African markets are too liquid, they're fragmented. You know, can institutional investors allocate meaningfully without the feeling that, you know, it's a token allocation? I think that's actually a critical word here, because, you know, in the olden days where you had 5% allocation to Africa, you know, investors will just put it as a token allocation. You know, can you talk us about, you know, whether a meaningful investment can be made into Africa and talk about all of these issues of liquidity fragmentation. Thank you, Keo.
Yeah. Yes, thanks, Malu. It is a fact that African markets are illiquid. And if you are going to invest in the stock markets in Africa, this is one of the key risks that you need to manage very carefully, and it needs to be top of mind. However, like I said, we have done the work. Of just a 5% allocation in Africa or African equities or African debt for that matter, just 5% in a balanced portfolio. I mean, we talk about meaningful allocations. Let's not go there. Just 5% not only improves your the returns of a balanced portfolio. And I'm talking here, I'm not talking about the balanced portfolio that is only South Africa and Africa. A balanced portfolio that is allocated more than 40% to equities in South Africa, 30% to global indices, like the AQUI or the MSCI World Index, developed world, and 5% allocation in Africa not only improves returns. I mean, this is backed by data measure. It not only improves returns, it improves your Sharpe ratio, your risk-adjusted returns also. So yes, Africa, with its challenges, will have a meaningful impact on your portfolio if you allocate to it. And just to wrap it, and go back also to your first question. So one thing that we have learned or that we have realized here is that, especially as a South African, I mean, Africa is in our name, South Africa. We find that we are more negative on the continent as the continent dwellers than the rest of the world. If you look at where most of the capital on the continent, or people who allocate capital on the continent, it is the investors in the US or in the USA and in the developed Europe and China. The question is, who is going to develop this continent if not us, the people on this continent? How is, and we need returns into the future, but those returns are going to come by investing in assets that are going to give us high growth on this continent.
Great. And then thank you, Keo. So, and then also, how do you mitigate the risk? And we talked about risk earlier, and we talk about us also being very cognizant of the risk. And most importantly, what we said is that there's a lot of perception of risk in Africa than real risk. So the question says, and it comes from Pindi. Thank you, Pindi, for that question. How do you mitigate risk associated with currency fluctuations and political instability within the portfolio?
Thank you. There are various ways to manage risks on the continent. One of the main risks, of the main ways that we manage risk on the continent is diversification. Like we said earlier, that is the only free lunch that exists out there. We diversify across different currencies. We diversify according to different countries. We diversify across companies, across sectors. And most importantly, I'll make an example about the post-COVID years where we have challenges in two of our biggest markets, Nigeria and Egypt, where we had currency challenges. In situations like that, how we manage risk is that we tend to buy companies. Firstly, companies that have pricing power, meaning that they can price up in periods of fast depreciating currencies because they raises costs. Companies that export, that earn dollars. And we tend to focus on banks that have positive dollar net open positions. Basically, how we manage risks, we manage it not only from the individual companies that we invest in, but we manage it also via diversification. Thank you.
Thank you. Maybe for you, Moses, if we can take the question from Owen. Or rather, I think, Vusi, the question of liquidity, I think we've been able to answer. And I think maybe just further on, places where you're not able to repatriate your money. So maybe just talk a little bit about that, Kio, where we had a scenario in Nigeria where when you invested in, you could not take your money out. So just talk about that, because Vusi talks about at maturity, when you want to take your money out of the country, how possible it is. So if you can just talk about the Nigerian experience there.
Yeah, and also the Egyptian experience, Malu. And like we said, yeah, we tend to manage that through investing in companies that will protect us in case of significant currency devaluations. But also, if we are, and we tend to be patient. We tend to be patient in the scenarios, and in situation where we don't have a choice, we tend to use implied rates on the continent. But that was in the past. We believe that that has changed going into the future. If we think about the structural reforms that have already been implemented, I mean, for all intents and purposes, the Naira is flexible. I mean, the Naira has touched 1,700 and it has come back to 1,530. So you can see the Naira is moving, and you can extend this also to the EGP, the Egyptian pound. But in the past, in situations like this, there's always companies, dual-listed companies. In Nigeria, it was Airtel Africa, which is a telecoms company, which is listed in both Nigeria and in London. It is the same stock. We buy it in Nigeria, we fund it or change ownership from Nigeria to London, and then we sell it in London. Basically, that's in Egypt, we use a commercial international bank to buy the asset in Egypt and then sell it in London, basically. We just change, it's just a change of ownership from Egypt to London. And in case of Egypt, actually, we instead of value destructions, I mean, we use the arbitrage between the two prices to actually make money for our clients in that situation.
Thanks, Kio. And I'm going to ask Moses to take the Trawa effect question. But before you do that, Moses, I just want to add a little bit to what Kio is saying. I think, yes, the reforms are happening in Africa, but they're happening slowly. I mean, the first one is these currencies where countries are now moving the currencies towards floating. We know that South Africa is the most liquid and floating currency, amongst the emerging market peers, and Africa is following suit. I mean, although the currencies were managed, slowly but surely, the countries are actually deregulating their currencies, letting them float, and with good examples of, the two major countries being Nigeria and Egypt. So Moses, over to you.
Thank you very much, Malu. So the Traore effect. Wow, this is a very, very difficult question to answer in my view. But as an African, like you rightly mentioned, Owen, in your question, that we've seen, it is easy to kick the emperors from a resource-rich back. Yeah, I mean, it's important to take back the resources in Africa, but the more important question is, how are we going to utilize or get economic value from these resources? How are we going to position ourselves to get economic value from these resources? We've seen the Traore effect happening more so in Francophone Africa, mainly due to what France has been doing within that region in terms of the currency, in terms of the central bank reserves sitting in France rather than in those individual countries. But we haven't seen the same coming through into the other regions in West Africa or Southern Africa. I think it does provide or give some element of confidence that we as Africans can be in charge of our own resources. But the next question is, okay, does he or would he set the right policies, put the right policies in place so that that the country is able to get economic value from the resources that it already has? And I think that's the difficult part, to be honest with you. Because he needs to increase intra-Africa trade with other African nations. We've seen, they've been kicked out from ECOWAS, which is the economic bloc in West Africa. But I think, he can position the country to take advantage of the African Continental Free Trade Area, position, the nation to take advantage of that. I think the potential is there. Is just putting in the right policy framework and basically ensuring that it is implemented. There's that political will, should I say, to implement the right political framework to ensure that there is economic value that trickles down from the resources within that country to the citizens within that country. But it's a very interesting situation that we're finding ourselves in. I'm not an advocate of, going down that route, going down the violent route. But, since we're already there, I think it's time just to look at the economic side. How can we uplift the people of that nation using the resources that he already has control over?
Thanks. And sorry, just to follow up on that, I mean, we, like Moses said, I mean, we're not a believer in the violent route. Yeah. And historically, Owen, if you look across the continent in the last while, the revolutions, they don't produce the best outcomes. I mean, I think history it's a guide on this. They don't produce the best outcomes for the populace unless the right economic policies are put in place to position the country for growth into the future. Strongman effect, just a strongman effect without the commensurate economic policies that uplift people out of poverty does not work.
Thank you, Moses and Keo. So another question comes from Bonginkosi Moyo, Bobo. Thank you very much for that question. What other key sectors in Africa, that show growth potential? And we mentioned, Dangote, which is really, as far as infrastructure is concerned, is well placed. What other key sectors, Keo, if you can just go through that? Thank you.
Yeah, thank you for your question, Bonginkosi. The telecoms and financial services. And telecoms here, we can talk about these traditional telecoms businesses, the GSM business, where it's the phone you call and data. But in Africa, telecoms are more than that. Telecoms are fintech operators. Telecoms are payments operators on the continent. Telecoms are actually driving financial inclusion on the continent. I mean, Moses spoke about how M-Pesa is part of their lives now, their daily lives, whether he's paying his driver in Kenya or he's paying the helper at his house, and whether he goes to a restaurant to have dinner with his wife. He does not need a bank card, just needs his phone and the way bill, whether he's taking an Uber or a taxi, a normal taxi. That's what's driving the net growth in the telecom sector on the continent. And like I said, it's also driving financial services. I mean, you look at almost all the telecom companies, and what is the fastest growing or revenue and profitability growing segment? That's fintech, or what they call mobile money on the continent. And mobile money has become much more than about cash in, cash out. When I say cash in, cash out, here I'm saying sending money to your family in the rural areas, and then they take it out and then they go buy bread or whatever. It has become a full ecosystem. For example, I'll let Moses talk about some of the products, lending products, savings products that a company like Safaricom has introduced. Over to you, Moses.
Thank you very much, Kyo. I mean, in the mobile money space, in terms of, for example, Safaricom, it just turned 18 years this year. And 10 years ago in 2015, it was doing about 600 transactions per second. As at this year, it's doing about 4,000 transactions per second. It has that capacity and capability. So in terms of it offers lending facilities, it offers overdraft facilities, it offers wealth management, i.e. you can have a money market product. It has a money market product and access in M-Pesa. You can do your savings in M-Pesa. You can book your flights using the M-Pesa app. You can book holidays using M-Pesa app. You can get insurance using M-Pesa. I mean, basically everything that your bank or your Visa card or MasterCard can do, M-Pesa can do, and can do in terms of scale. It can do practically every facet of your life. M-Pesa has touched within Kenya. So it is very ingrained in our day-to-day lives, and it's very, very difficult to go a day without using that app, to be honest with you. So it shows the sort of potential that M-Pesa or mobile money has across Africa. Like we mentioned earlier, that Africa is a global lead in mobile money, transacting 1.1 trillion last year versus globally of 1.7 trillion in terms of value. So that's just one country. In Kenya, you imagine M-Pesa growing, now they're in Ethiopia and they're trying to replicate the same. M-Pesa Africa, can access all the way from Egypt all the way down to SA, and taking into Airtel, MTN, Momo, Vodafone's M-Pesa, it touches all facets of life for majority of the 54 African countries.
Yeah, and also just to add, I mean, we spoke about financial services. I mean, banks.
Yeah.
For any country, if you think about the China for the past 30, 40 years, what has been driving China's economy? We can talk about manufacturing and exports, but housing. And housing or property comes through the ability to access financial services, the ability to access a bond that you can pay over 20, 30 years. It's a massive opportunity that exists on the continent. South Africa currently and Morocco and probably Namibia and to a certain extent Botswana, those are the only few countries where an average person that has a 9-to-5 job can get a mortgage.
Yeah.
That's a massive opportunity that exists on the continent. That's not only affects housing from the infrastructure perspective, but also it affects banking penetration on the continent. And the consumer space also, like we said, in talking about opportunities that exist on the continent. We talk about going to ShopRite to buy groceries. That's not a luxury that is available to most people on the continent. And that is we see, instead of seeing that as a negative, we see that as an opportunity. I mean, we see companies like, just to add, Label V in Morocco, that is building almost 100 stores a year.
Yeah, can I just chime in?
Yeah. Sorry. In fact, I also wanted you guys to speak about even, for example, basic things like hospitals, guys. I mean, in Egypt, if you look at hospital beds, per capita, and how low that is, and the potential of that growth. I mean, so I think you can elaborate on some of those, guys. Yeah.
Moses?
Yeah. I mean, it's it's in all sectors where we're seeing significant growth. Like in the mortgage sector, I just want to give a practical example. In Kenya, a country with about 55 million people in terms of population. We have, some of the biggest banks in East and Central Africa. But just to give you an idea of the low mortgage penetration in this part of the world, Kenya only has 40,000 mortgage accounts,
Wow.
versus a population of 55 million people. So it shows there is significant room or runway to grow in terms of the financial sector. If you go into the healthcare system, like what Malu mentioned, the bed space, it's low. If you look at Egypt, there's a huge private sector player. Sorry, a listed player, but called Cleopatra. I mean, they are trying to change that. They are investing significantly in the hospital, in the health segment in Egypt, and they have been doing that very profitably and are touching and improving lives in that part of the world. So across all sectors within the economy of the Africa GDP, there is low penetration and significant runway to grow.
Thank you, gentlemen. And maybe the last part of Bongikosi's question, I'll just give a quick answer there. So, Bongikosi, if you look at the African markets, if you want to compare that to traditional international markets, one of the big thing we've mentioned earlier about Africa is the fact that it's got this massive population of 1.4 billion, and that population is growing, at a massive rate. So that alone, cannot be compared to the international market or the developed world, given that the developed world are struggling with aging population and populations that are going down. Then there's labor shortages and the like. So we've got actually the opposite problem. We've got the opposite, in terms of a high growth population that is 1.4 billion. And I think that's one of the biggest assets. And I think one of the other things that we did mention actually in our discussion today is the resources, how resource rich South Africa is, Africa is, and especially with those just transition commodities, in order to move towards a cleaner world. You're talking about copper, you're talking about nickel. All of these, commodities, we've got them in abundance in Africa, and those will be in demand. And you've seen the investments coming from China, investing in road, rail, ports to be able to get those commodities. So I think that we're not going to be correlated to international markets, and we're not going to stagnate, so to say, like those other markets. We're actually on a growth trajectory as a continent. So just maybe to finish up.
Sorry, just before you go there, I also just want to add on that, because I mean, currently, Bongikosi, you look at the globe. I mean, I'm just taking it from the globe, not from Africa. It's like, what are you paying for asset prices currently in the US and in Europe versus what you're paying for the asset prices here in Africa? It's, for lack of a better word, it's chalk and cheese. You're paying currently, we're talking about paying 27 times on average. I'm talking about average on the S&P, average PE, price to earnings. In Africa, you're paying less than 8 currently. And if you think about just the current developments, when we talk about the global backdrop, we spoke about tariffs. The fact of the matter is that's going to lead to slow growth, and slow growth leads to slow earnings. Yes, the first half, I mean, because they've been on and off, you're not going to see that you don't see that in the first half of the year. But now that those tariffs are being implemented, let's see what happens in the second half of the year, in first half of 2026. Now, when the real impact and the long-term impact, we not only, I mean, there'll be short-term impact and there'll be long-term impact. Now, you tell me as an investor, are you willing to pay 27 times for assets, which is, if you think about it as a payback, I mean, 27 years to get your money back versus 8 years. And this includes Morocco. Yeah, if you exclude Morocco out of that, you are paying less than 6 times earnings on the continent. So that is just perspective and a high growth potential.
Thanks, Keo. Then the last two questions that we have today, beyond GDP growth numbers, reforms, etc., what are the structural bottlenecks that could quietly cap the returns in Africa? And then, okay, so and then let's read even the last one, and you can ask those, answer those together. Optimistic focus assume growth will continue uninterrupted. That's what the question is saying. How would your investment, thesis hold if there is another continent-wide crisis, like a commodity shock, energy blackouts, or political upheaval?
Yeah, I'll start with your first question, beyond GDP growth numbers and reforms. Structural bottlenecks is the infrastructure that we, I mean, we just, when we say Africa is alive with possibilities here, Meshach, we're talking about fixing those structural bottlenecks, which is, if you think about it, it is the infrastructure, it is the power. Africa needs to invest, or us as investors, we need to invest in those assets. We need to invest in improving roads, rail infrastructure. I mean, if you think about what is happening now in the Eastern DRC, I mean, besides the conflict, right, that most of the mining happens in the east, and the port is in Kinshasa, which is thousands of kilometers away. You need a railway infrastructure to move that produce. I mean, currently, I think most of the stuff goes either via the neighbors on the other side, Tanzania or Kenya, or Rwanda. You need the infrastructure to move that product to the port in Kinshasa. We need to invest in that infrastructure. We don't see those as bottlenecks, but we see them as opportunities. Optimistic on the forecast? No, we do not assume that growth will be uninterrupted. We are investors. We always say, if you look at the graphs in investments, Meshach, it moves like this. If you look at it in the short term, it will look like a straight line going like this. But over the short term, it will, So basically, we do not assume that growth will be uninterrupted. But I mean, you look at the past since 2000, actually, and Moses can talk to that. Yep. Growth on the continent since when the reforms happened in the early 2000s about debt forgiveness and all those things, that the growth has been fairly consistent on the continent, despite the financial crisis in 2008, despite the COVID. I mean, if you look at the COVID years, few African countries hit negative GDP growth. Despite the challenges. You talk about currently the wars, the Ukraine war that brought a lot of inflation on the continent and food risks. Still, the continent grew despite those challenges. Basically what we're saying here is that Africa is growing despite the challenges. And yes, the reforms are slow, but they are coming through. And and we keep on saying that they are slow. But if you think about it, reforms in Nigeria were slow until they happened.
Yep.
So yes, they are slow, but sometimes they are fast. They're quick. They just happen. The guys just, put a shock into this economy and move on.
Thank you, Keo. So Moses, do you want to come in?
Yeah. Thank you, Malu. Meshach, thank you for your questions. I mean, like what Keo mentioned in terms of structural bottlenecks, it's largely infrastructure. And like I mentioned earlier, it's if you look at the diaspora remittances coming through into Africa, you look at a country like Egypt, it gets about $22 billion per annum. You look at Nigeria, it's about $19 billion per annum. So in aggregate, Africa in 2025, it's estimated will get about $100 billion. So imagine issuing a local bond that targets diaspora remittances and using that bond to replace basically the expensive external borrowing, thereby reducing your currency risk because you are reducing your dollar reliance, and issuing local bonds across the different capital markets in Africa, targeting the diaspora funds coming in. I think, Africa, by instituting such reforms, Africa would be in a very strong position to basically self-finance and to address these structural bottlenecks. Just to give you an example, when in 2023, the new president in Kenya, the current president, came into power in September 2023, and in June 2024. There was a maturity of a bond at it was about $2 billion worth of a Euro bond due in June 2024. So there was already the aspect of viewing Kenya as heading to default, and there was a heightened risk. We saw that in the FX that moved from about 100 shillings to 160 shillings in terms of deval. We saw, ratings from Moody's, S&P's, declining, but Kenya had already anticipated this and had already moved very quickly in terms of getting into a program with the IMF in 2021, 2022 to address this situation. And by February 2024, Kenya basically paid up that Eurobond, basically refinanced it, and they got a very significant flow coming through. So in terms of reforms, they are there, and like what Keo mentioned, that even though they are slow, they only are slow until when they're implemented, as we've seen in the Kenyan case, as we've seen in the Nigerian case, as we're seeing in Egypt, as we're seeing in Ethiopia, Ghana, Zambia. There's so many cases across Africa that we're seeing reforms coming through, and that is impacting GDP, putting them in a better position, competitive position across and getting accolades from the IMF. So it is working, it is happening. It's just getting them implemented as quickly as possible. Thank you, Malu.
Thank you, Moses. Thanks, Keo. And the other comment I wanted to make is that we had one of our colleagues who's retired now in Ghana. He works for a long time in Japan, and he used to explain to us that the word risk in Japanese is kiki, K-I-K-I. So which means that and that K-I-K-I you split in half. The one K-I, it means danger, and then the other K-I means opportunity. So yes, we can see a lot of risk in Africa, but there's massive opportunities. And I think a lot of people are scared to look into Africa. A lot of investors are scared to look into Africa, thinking a lot about risk, but there's massive opportunities in Africa. And some of the bottlenecks that are happening, one of the great investment that is happening across the continent today is actually the investment in border posts. Some of these border posts are blockages where cargo stands in these border posts for days, 4 days up to 5 days. But today, if you look at the Braid Bridge, which is a border post that's just been built now, brand new, it takes maximum 4 hours for a truck with cargo to get in and out of the border posts. And these are some of the things that are happening as we speak here today. And the likes of DFIs, are investing across the continent. The likes of GPF, PRC, allocate to infrastructure funds across the continent. I think that work is happening. In fact, one day I took a train, rather a 6 o'clock flight to Botswana. And let me tell you, in that plane, it was full of South African engineers that are going to Botswana, building roads, building dams, building, power stations, So behind the scenes, there's a lot of work that is happening. And while some of us see risk, there is huge amount of opportunities. So ladies and gents, I'm cognizant of the time. and you really have been very generous with your time this morning in our webinar. We really appreciate your attendance. We appreciate your engagement, your questions, and please work with us to rebuild this wonderful continent. It's not a dark continent. It's a continent full with opportunities and possibilities. Thank you, my panelists, and thank you, Nolita, for organizing this wonderful webinar. And thank you, ladies and gents, for your attendance. We appreciate your time. And thank you, thank you.
Thank you.
Thank you.
Thank you.